looks like we have a critical mass, so we can go ahead and get started. Again, I'm Gene Gard, Chief Investment Officer here at Telarray, and I'm just sharing my screen here. Unfortunately, Chelsea couldn't join us tonight, so we don't have a moderator, but I will try to monitor the chat box and try to keep up with the questions. And if you have any questions, please do answer, or I'm sorry, please do ask, and we'll definitely do our best to answer. Okay, I think that's up there. Good. Yeah, so here we are, 2023. And as we promised in the teaser, we're going to try to just briefly review some of the events of 2022, and then more importantly, talk about what the future might hold for 2023. So really, we only have one slide looking backwards on 2022, which again, some of our slides here we were able to get from JP Morgan Asset Management, which does a pretty good job of creating some of these graphics. So I think really this tells the story of 2022. A 60-40 portfolio, so 60% stocks and 40% bonds, had, I wouldn't say it's one of the worst years. It's not the worst year ever. It's definitely one of the worst years ever. But I think what was really distinctive about it is that if you look, the stock and the bond returns were both pretty negative. And more importantly, if you look back at previous observations, you can see the green is the line for equity returns, and then the gray is the line for fixed income returns. It's really hard to find a year where there's a negative gray bar at all for bonds, for fixed income. And you can see in most years, in most down years, you can see that the gray lines kind of support the green lines and help out. But it was a very unique year because we were sort of at the end of this cycle where bonds were set up to be in a rising interest rate environment where it just wasn't favorable for bonds. But then also due to the actions of the Fed and some of the geopolitical things happening, it just wasn't a great year for stocks either. So a negative 16% return for a 60-40 portfolio is not great. And I had a lot of people questioning the value of bonds, questioning if bonds were appropriate. Fortunately, if you've taken a look at your statement from Telarray, you'll see that really our returns were pretty similar across all of our portfolios, which really our portfolios are pretty consistent, except that it just varies from, close to 0% bonds all the way up to maybe 50 or 60% bonds. And I think what you would see if you looked is that, fortunately, this is just a very broad-based index sort of benchmark. Due to some of our tilts, our factor tilts towards things like value and small cap and international at the end of the year, we didn't do quite that bad, but it definitely was a scary year for the concept of the 60-40 portfolio, or the concept of a balanced portfolio of stocks and bonds. The good news is we think it was definitely a one-time, well, not necessarily a one-time event, but certainly an unusual event. And what I really mean by that is that no paradigm changed where we expect a bunch of years in the future to look like this rather than all the other years throughout history. I mean, there's going to be positive years and negative years, but we think that bonds will continue to be an important part of the portfolio. And even here at Telarray, if you take a look at your statements, what I think you'll see, I can't think of many exceptions, is that normally we say that in a good year, stocks will probably do well, bonds will probably be flat or up a little bit, and that's a good year for your portfolio. In what we call a bad year, which is a bad year for stocks, we would expect that the bonds would somehow mute your drawdown and probably, hopefully, be flat or be up, but definitely perform better than stocks. And what we did find last year is, even though it was a crazy year for bonds, that actually did work, in the sense that even though our bond returns were disappointing in some cases, in an absolute sense, in a relative sense, it turns out the more bonds you had in the portfolio, the better off you would have ended up, which is exactly what we hope for in a rough year. So even in a bad year like this, you still were better off having more bonds. So I think, like we've kind of beat the drum on, the death of bonds is greatly overstated. So the next thing here, I'm going to go through just a few headlines I clipped from some different forward-looking 2023 outlook. So you can see Schwab says, there's probably some good things going to happen in 2023, but they might get worse before they get better. This was Edward Jones. They talk about turning the corner again, but it's sort of expected to be bumpy, but then ultimately steer in a positive direction. JP Morgan said stocks set to fall near term as economic growth slows, which I guess maybe they're just looking at the first quarter or so. Goldman says the bear market in stocks is forecast to intensify before giving way to more hopeful signs later in 2023. I really don't, I've read through these forecasts, and it's really hard for us here to understand how you would go about forecasting stuff like that. I guess the main themes of the year are that the Fed is hiking. They're likely to slow, particularly in their February meeting, and potentially even pause later in the year. The notion of a recession is so widespread and seemingly inevitable that I guess everybody thinks the recession is coming in 2023. But as I pointed out, if you read our quarterly letter that came out at the end of December or the beginning of January, it's even to the point where I think Fortune put on their 2023 annual, they called it the recession playbook, which, as you know, magazine covers are a very poor predictor of future economic performance ever since the death of equities won on Business Week in 1979. So the point is, I think that all these people, if you're publishing an actual forecast where you're trying to guess what's going to happen in the coming year, I think it's very scary to be optimistic. But I think if you really think about it, it's hard not to be optimistic in any given year. What I've told people and what I wrote in the letter at the beginning of this month is, if you look back in time, there's probably never a year where on January 1st you said, well, this is it. This is going to be a really fantastic year. I'm going to just do everything I can to get fully invested because I'm sure this is going to be great. Every year there's geopolitical risks, there's wars, there's conflicts, there's contagions, there's threats of recessions. Either the markets and the economy are bad and it's going to stay bad, or else it's been too good and we're due for a fall. So I really don't put much value in any of these forecasts, which all sort of say the same thing in a very vague and non-specific way. So what we will do is we'll take a look at some actual data that definitely defines the moment now and probably will influence the rest of 2023. But we're not ready to make any kind of prediction other than, if you look at history, something like 75% of years tend to be positive in the stock market, at least in the US, and 25% of years are down. So if you bet every year, you certainly would want to bet on an up year, and markets do climb the wall of worry. So we don't know what's going to happen next year or this year, but I'm probably just as optimistic as any year right now going forward. So back to the idea of recessions, it's interesting to look at. This is kind of a heat map. You can see going into the beginning of 2020, everything turned red, all these different things, and sure enough, that was a pretty severe recession caused by the COVID stuff. But going forward, if you come to the present day, I mean, the only things that are really showing up negative, industrial production is down, which is certainly influenced by the Fed's tightening and Fed's actions. Sorry, just a moment. I lost the chat box here. I just want to make sure I'm paying attention if anybody has a question, especially since we don't have a moderator. Okay, that's better. And so the other thing we see here is real wholesale and retail sales, which again is trending not positively, but that's not surprising again with interest rates and the effect it's had on the consumer and things like that. But the things that are saying green or yellow or relatively positive are real personal income, non-farm payroll, household survey employment, real consumer spending. So with all those things in mind, if those trends persist, it's hard a little bit to figure out exactly how we would get a recession unless something very dramatic changes or inflation persists and the Fed really has to break the back of it. But we'll talk more about that. And it looks for right now like inflation is certainly not persisting, which is good news. And then just, I want to increasingly focus on global positions in these reports because, again, we are globally diversified here at Telarray. Roughly 60-40 between the US and non-US stocks. It does drift around, but you can see here, if you look worldwide, things look pretty positive. I mean, things are turning yellow, maybe a little bit orange across these different parts of the world. But you can look, there's a lot of periods where things were yellow or a little bit orange in places, and there was no real recession. I mean, if you think about the big recessions, we had one in 2008. It got a little choppy around here, but there wasn't really another meaningful one until the 2020 lockdown recession. So Again, there's no real alarm bells here yet, in my opinion. This one is perhaps suggests a recession might be on the way. This is leading economic indicators. And you can see that when the chart dips below the 0% line, that's when recessions, which are indicated by these blue shaded regions, happen. That's when recessions occur. And you can see that sometimes it does dip below with no recession. There's some observations of that, but there's not a lot of observations where it dips this far below without a recession. So one thing to add about that is it's very possible that we're in the midst of a recession right now. When you see a bar like this was the GFC in 2008 that stretched from, I think they actually called it maybe even at the end of 2007. But anyway, it was a pretty long recession, but it's not as though that right at this point they knew we were in recession and then right at this point they knew we were out. The recession doesn't actually get declared until pretty far into it, and then it doesn't get declared over until we're well out of it, and usually the market is significantly recovered. So when people say stuff like, I'm going to wait to invest until this recession is over, that's kind of like when people say, I'm not going to hold bonds until the Fed stops hiking rates. And the reason for that is that's something that's logical, and it's a cause and effect kind of thing. But as a practical matter, we all know that by the time things are certain and by the time everything is obvious, chances are you've missed the opportunity in the market. And some of the biggest returns come at the darkest times in the market, which is actually when things are actually changing. So, this is definitely, this would suggest we might be on the way to a recession, but there's certainly no guarantees, and it could be that we've actually experienced a recession and we're out of it already. That's possible. A big theme also in our talk today is going to be about the US dollar. Again, if you looked at, we try to avoid putting any kind of performance information actually in these presentations because there's just a lot of compliance that goes with it and it's more difficult to share. But if you looked at your statements, I think what you would see is that our international and emerging positions were extremely strong in the fourth quarter of 2022. And a big part of that is because of the US dollar. And you can see after peaking, the dollar has really kind of been on a slide ever since then. We talked about this in the letter as well, but there's no obvious indication of what is going to support the dollar in the short term. And in other words, this slide very well could continue. And it might seem bad for the US, but it's actually not necessarily bad for the US in the sense that our exports become more attractive, and there's actually some good things that happen even for us. But this is great news for the rest of the world because the oil is priced in dollars, and oil drives the entire world's economy. So not only does energy become much cheaper as the dollar falls compared to other currencies, but also particularly emerging countries that sometimes have to price their bonds and price their debt payments in US dollars to get the bonds to be attractive to investors. They get an extreme windfall if the dollar weakens against their currencies. So the good news there is that our international positions were absolutely on fire in the fourth quarter of 2022. And already this year, again, I don't want to get into specifics, but if you look, say, if you even just look at broad market indices, you would see that right now, emerging markets, which have struggled a little bit over time, particularly as the dollar has strengthened over the last 5 or 10 years, emerging markets are, at least for us, by far on top of the heap as far as the best performer in 2023. In fact, if you stop the year right now, I would be very happy with the performance of our emerging fund, even if that was the full year of 2023. But we're only a couple of weeks into it, so while again we don't know what's going to happen, there is a possibility that we could have a real confirming kind of meaningful year for emerging markets, as well as our other international positions. The trends of last quarter could definitely continue. So since everything is so driven by the Fed, I do want to talk about the Fed and looking into 2023, what they might be up to. We always show this. This is the yield curve. So it's a big change. You can see that if you look 1 year ago, the short end was still essentially 0% Fed funds, or sorry, 0% yields as far as the Treasury curve. And the whole curve really topped out at about a 2% 30-year, which is hard to imagine now. Since then, everything has really exploded upwards. You can see the gold line is what the yield curve was at the end of last year, so just a few weeks ago. And the blue line is where it is today. So If anything, as we've talked about before, the yield curve inverting, meaning that the short-term yields are better than the long-term yields, that also is a sign of recession, or at least something, some kind of funny business in the economy. But what's really happened, and some people predicted this earlier in the year, is that really this long end of the curve going out, to between 10 years and 30 years is really going to stay kind of anchored at that 3.5% level. And there's a lot of reasons for that. One of which is it kind of needs to stay there for mortgages to be at all affordable, which you may argue they're not right now, but also for the debt service for the treasuries, and a lot of reasons that these longer yields might stay constant. But you can see the Fed has pushed the short-term rates really high. And so what a yield curve like that usually means is that there's some expectation that these short rates might start falling again soon. I think if there was market belief that these short rates would stay elevated like this, I think it's likely that we would get an upward sloping yield curve that looks something like this. But I think what the long end is telling us here is that it thinks that these short-term rates are temporary and are likely to come back down. It's really interesting when people look at a yield curve like this, and people say this all the time, and I've had this in other professional situations and actually argued with people. I think I just hit escape accidentally. Let me see if I can. There we go. Sorry about that. I was trying to move my microphone and hit escape. But what's really interesting is people will say, looking at this yield curve, they'd say, oh my gosh, I can't imagine buying, say, a 10-year, let's just look at the blue line. I can't imagine buying a 10-year treasury at 3.52% yield when I could buy a 1-year treasury for almost 5%. Why would I be stupid enough to buy 10 years out if I can get paid so much more to stay short and not have that duration risk? And that is true, particularly if you think, if you're a doomsday kind of person that thinks that interest rates are just going to go infinitely higher forever, which they really have never done that before, and they probably never will, in my opinion. But I think what the reason that's not necessarily the right way to think about it is, imagine if everything got back to normal and this blue line next year shifted down to the red line. Well, after a year, you'd enjoy your 5% yield on your 1-year bonds, but then you'd be reinvesting that money at nothing. Whereas if you bought a 10-year treasury and then the yield curve shifted to look like this red one, you'd be picking up that 3.52% yield for 10 whole years. Whereas again, if you had to reinvest the money, even if you did go 10 years out, you'd only be getting 1.75 on it after the reinvestment started. So the short answer is, the reason anybody would consider going out longer for less yield is because you actually get protected on that. You lock it in and protect yourself if yields fall greatly. And of course, that may not happen necessarily. And of course, if yields did fall that much, there'd be a lot of good things that would happen, like mortgages would get a lot cheaper again and things like that. But it is something different, definitely interesting to think about. The extreme example is, and I'm making up these numbers, but if you think about the peak of interest rates in the early 1980s, I mean, imagine if somebody said, why would I buy and again, these numbers are probably in the ballpark, but off. They might say, why would I buy a 30-year treasury yielding 20% when I could buy a 1-year treasury yielding 24% or whatever the difference was? And the answer is, again, I mean, it's great to get the 24%, but getting that 30-year treasury at some ridiculously high yield for 30 years, that's a real opportunity. And that's why people think about that part of the curve other than that part of the curve. So we kind of dwelled on that for a while. This is yield curve steepness. We already talked about that, and the 2-year to 10-year is inverted, and actually inverted more than really any other time other than the wild times we were just talking about around 1980 to 1985. But I think what's interesting about this chart is it does show that the inversion happens a long time before a recession actually takes place. 17 months, 9 months, 19 months, 13 months, 23 months here. So we've had this big inversion, but it's entirely possible that the recession it's predicting, like I said, there's some argument that maybe it already happened, but on the other hand, it could be that this recession that it's predicting might not even materialize in 2023. It could be sometime beyond that. And that's why we just truly believe, and I think evidence bears it out, that you can't try to time this stuff, that you just need to stay invested, keep putting your money to work and just look to the long term for your long-term success. This chart I really enjoy. I've always said this is one of my favorite charts. It shows if you got basically a 1-year CD, if you put $100,000 in it, if you did that in 1990, you would have gotten something like $10,000 back. And if you did it today, you would have gotten something like $1,200 in return. But what's important is to take that into account after inflation, which is what this gold line is. And you can see there was a time when real interest rates on the 1-year kind of part of the curve got so negative that I mean, you were losing significant buying power. I mean, close to $10% of your which it makes sense if you have 0% rates almost, and then inflation is 8 or 10%, then that's like you're losing 8 or 10% of purchasing power every year. But you can see the good news is that yields have come up some, and these real returns have come up some. So cash is still, wouldn't say cash is king. I'd still kind of say cash is trash, but at least it's not quite as trash as it was before. We've talked about this before, but this is the real yield curve, and it's interesting. If you look 1 year ago, pretty much across the Treasury curve, real yields were negative, so after inflation. But what's nice is if you look at the real yield now, which is judged by the TIPS market, you can see at least to the 5-year part of the curve and beyond, we pushed to having positive real rates pretty much across the curve, which is good news in a lot of ways. The negative real yields does benefit us in some ways because it does help us reduce debt to GDP for the government. But it is nice that at least if you put your money to work 5 years or longer, you're not actively losing purchasing power, which is especially detrimental to pension plans and big institutional investors and income investors. Particularly older people that like to be in bonds just for the security of it. At least there's something there for them more so than before. So what is the Fed going to do in 2023? That's a good question, but I think this is a good chart from JP Morgan that kind of helps explain that. So if you look where we are right now, the Fed funds rate is in the 4.25% to 4.5% range. So if you look at what the Fed predicted at the end of the year, you can see they think they're going to get as high as 5.1%, which is it's basically a 75 basis point hike from where we are right now, but then relatively rapidly it'll start coming down, at least in the future years. But what the green is the market expectations. You can see that they think the Fed is supposed to be credible, and the Fed is supposed to be they're supposed to try to downplay inflation expectations. So they're incentivized to overestimate their commitment to keeping interest rates high. But you can see the market thinks probably things are going to cut a lot faster than the Fed predicts. And everybody seems to be pointing toward this long run kind of 2.5% Fed funds rate expectation, which is close to the target of inflation itself, which the Fed has stated is around 2%. So I guess the good news here is that the market thinks the Fed's going to cut a little faster than even the Fed does. If you look going forward, I think we talked about this, but there was part of the excitement in the stock market in the last couple of weeks has been that it's pretty much baked in. I think if you look at futures, there's about a 99% chance that the Fed is going to hike 25 basis points at this next meeting. And then there's a lot of question of if they're going to hike maybe another 25 at the next meeting after February, or if it's possible that they'll actually pause. And I think once, it probably won't matter the day they actually pause, but once there's an actual consensus that they're going to pause, I think that's going to be a big positive for the markets and another reason to be invested. Again, we don't know the future. One thing we can say for sure is they will pause eventually. They can't just hike rates forever. So when people start getting the sense that they're going to pause, that's a great time to be in the market, and you can't really take advantage of that unless you're already in there. So again, no reason to time it. Almost certainly they'll have to cut eventually as well, just in the basic notion of the business cycle. So there's speculation that could happen mid-year, toward the end of the year. It seems like the consensus is that they will actually potentially start cutting sometime in 2023, and if not, in 2024. So it seems like this has all happened so fast, but we're very much approaching the peak of this cycle, at least as far as Fed fund rate goes. And, there's always what goes up must come down. So we'll be in a rate cutting environment someday in the future, but we don't know if it's in 2023 or not. So I think this is an important chart because it shows everybody talks about interest rates and the way the Fed supported the market by lowering interest rates so aggressively. But one thing to not overstate is how important their bond buying program was. And you can see this Federal Reserve balance sheet. It just means basically how much, well, it used to mean how many treasuries they own, but since they started buying a whole lot of other stuff, there's other assets on this balance sheet. But you can see they started very actively supporting the market and buying trillions of dollars in treasuries and other assets. And they kept rolling that up. And then finally they said, we're not going to buy any more. And then not only that, but as they start rolling off, as the shorter term holdings start maturing, we're not going to replace them. So you can see that their balance sheet is actually starting to decline again. You could Monday morning quarterback, but you can see as far as the response from the pandemic and then the support they provided in 2012, they kept juicing up their balance sheet, of course, not quite to the levels we are now. And then they held it very steady for a long time and tried to just control things through the Fed funds rate here. You can see in 16, they started hiking. They didn't start reducing their balance sheet, but in 16, they did start hiking into 2019. And then just at the end, they started thinking about reducing and they actually started rolling off holdings. But then, of course, everything took off with the pandemic. So it's real interesting to see if they're going to be able to continue to let the balance sheet roll off or potentially start actively reducing the balance sheet, which is it's a activity that's very much like hiking interest rates. But I think it would be nice if we could see this come down and normalize some. So one thing to look at in 2023 is if we can continue this pace of the runoff. And what might happen is maybe we could level off the Fed funds rate, but still start reducing this balance sheet a little bit. If for no other reason, then it's nice to have some capacity for the next crisis, whatever that may be. So something to think about. This is something that's really important, which is the budget deficit to GDP. And the reason for that is it drives the debt to GDP. So you can see in 2020, it was about the worst we'd ever had. I mean, what this really means is 15%, essentially, if you look at all of, if the line was at zero, that would mean, well, let me see if I'm saying this right. Well, what I really want to talk about is this one. So let's go to this one. I think the other one is not great. The point is, if you look at, and I don't believe in looking at net debt, I really believe in looking at total debt, because I think treasuries the Social Security Administration owns in the trusts are very much obligations that have to be paid. So I do believe in looking at total debt. You can see we peaked out close to 130%. And so what that means is that if the US produces something like $22 trillion in the economy. Now it's around there. I don't know the exact number, but essentially, if it was 100%, that would mean that the federal debt was $22 trillion. And so you can see that we actually, the federal government owns 120% of everything we produce in a year right now, which is a huge, huge, huge number. And if you look at emerging currencies, that's a big red flag when this debt to GDP for countries starts getting this high, especially once it starts breaching 130%, 140%. That's when countries just can't overcome it, and they have to take some pretty dramatic changes, like devaluing their currency or restructuring their debt, which is a nice way of saying not necessarily paying all of it. We don't think that the U.S. is at all close to that at this time. But I think from this peak, which was difficult to control because of the pandemic lockdowns, it's very nice to see this trend going downward. And again, part of the reason this is going downward is because of inflation, in the sense that if you think about it's sort of like a mortgage. If you got a mortgage in 1980 for $100,000 and your payment is $400 a month, well, in 2010, when you're about to make your last payment, it's nice that you're still paying a couple $100 a month for your mortgage, even though your house is appreciated dramatically, because essentially the debt in your mortgage was inflated away. And in the same way, if we have inflation, then it means that the value of the debt compared, because GDP goes up with inflation, but but the debt is a fixed amount unless you pay it down. So the point is inflation is helping this ratio go down. And the only hope is that we can at least stabilize. It would be nice to continue this trend, but hopefully we can at least stabilize and not continue to see this rise over time, because it's probably fine now, but as it creeps up, it'll be a problem. So this is something that I'm looking very closely at in 2023 as we think about the future. We want to talk about inflation for sure. That's a big topic for everybody. And we didn't even lead with the CPI. You know, the biggest thing that's driving inflation is probably still energy, so gasoline prices. And you can see we've been fortunate that from the peak here in mid-2022, we're down to, we've ticked back up a little bit, but this is a big driver of why inflation has started to tame. And hopefully we can see that at least maintain, or maybe even pricing get a little bit more favorable over time. So CPI has ticked down to 6.5%, and core CPI has ticked down to 5.7%, which is definitely a good trend, and we're definitely on the right track. If you want to decompose that a little bit, this is a good heat map from JP Morgan. If you look down the line here, so if you look at the end of 2022, if it's green, that means its prices are falling or reasonably flat, and then if it's yellow, it's more. But if you go down the line here, you can see these contributors, gasoline, electricity, all that's pretty favorable right now, coming down. Food prices were a big problem in early 2023, but they haven't gone down much. They've at least sort of stabilized. So the only thing that's really still pretty spicy as far as inflation goes, at least for the December observation, is shelter, rent, owner's equivalent rent, which looks at housing prices. All those are still experiencing some meaningful inflation. But if you look at the numbers, it is good news that you know, we really peaked, just going across headline CPI here, which I think is important. We peaked at about 9%, and then really we've been sort of in free fall since then, losing, you know, over 6 months, we've lost about 2.5%, 3% on the inflation number. So if that trend keeps up, I think everybody will be really happy. So again, I wanted to talk about global stuff as well. And so it's an interesting question. Is everybody having inflation problems, or is it just us? And the answer is, if you look at the end of 2022, it's really, you know, developed markets are having more inflation than emerging markets, which is kind of an interesting, it's kind of like opposite day, which is another reason that emerging is really shining right now, is because they have some favorable pricing trends there. But going down, it looks like, you know, Italy is not having as significant inflation as some other countries, which, you know, probably is driven somewhat by the economy in Italy, which isn't necessarily the greatest news. But it's really interesting that China has slowed down. So China has been, you know, they've been growing GDP at an incredible rate for the last 20 years. It's been 8, 10, 12%. I mean, there's all kinds of really high observations, but it's interesting that they're slowing down, and it could be that this is a sign. Not that they've gotten ahead of themselves, but they're starting to have some serious issues as far as their long-term economic growth goes. They've pulled so many people out of poverty into the lower class to the middle class, as we would define it. They've done so much economically, but also they've, you know, there's been some decisions about the way they've approached the housing market, what they've built, the kind of things they've focused on. You know, they have a huge demographic problem coming just because they only recently lifted the one-child policy. So again, it's kind of opposite day a little bit, that they really are not a bright spot of inflation. And same with Brazil, same with India, particularly Brazil. You know, Brazil has been one that has had some issues. So it's really interesting. And I think what it does show is there's not really any particular dark spots. Everybody's kind of in the same shape, except for you know, ironically, some of the emerging countries are doing a little better. I love this chart just because it helps visualize what's happening with inflation. So you can see that in this last observation, it's nice to see this trend downwards. Energy is a tiny part of the inflation in December. Food at home has stayed pretty consistent over the year. It's still a meaningful contributor. Can't say much about that, but restaurants, hotels, and transportation, you know, as people have traveled more and as people have pent up travel and vacation demand, actually restaurants, hotels, and transportation has some meaningful inflation. But the nice thing about that is it's generally pretty optional, things like business travel, vacations, eating out. If you don't feel comfortable spending extra money on it, you don't really have to. It's not like food at home or gasoline or something like that. But shelter is the one that really still is taking off. And ironically, it's not so much because housing prices are rising as far as single family homes and things like that, but it's just really continuing pressure on rents, which there's a lot of reasons contributing to that, but there's hope that maybe that'll stabilize as well. Let's see, I think we, this just shows kind of the volatility of oil prices, but after what we experienced in 2020, there's some hope that can continue to fall or stabilize. And it's nice to see that energy right now, at least, is not a big contributor like it was to the inflation problems we were having in early to mid 22. We kind of already talked about that. Well, actually, let me go back to that. So with TIPS break-evens, what this is it's an actual, it's a traded security that's inflation protected. And what that means is you can actually use math to determine the market's expectations for inflation. Whereas, you would buy this bond if you think inflation is going to be higher than the number that's shown here, and you'd buy a regular treasury if inflation was going to be lower. And you can see the great news is that both the 5-year and the 10-year TIPS break-evens are right at 2.3%, which is fantastic news because it's the market saying that they think the Fed is credible and the Fed is going to get inflation to around that level in the coming years. And in fact, even the 5-year, that's good news because it means the annualized inflation over the next 5 years is expected to be 2.3%. So that includes the higher inflation we have now. So if anything, it suggests it might get a little lower toward the end of the 5 years. And consumer inflation expectations, again, there's not much use for surveys in economics, in my opinion, except for with inflation, because consumer expectations actually create inflation. It's a feedback loop that actually matters. And the great news there is, again, if you look at consumers think that we'll get inflation down to average 4% over the next year. So that's a pretty big decline. And then over 5 years, it'll average out to 3%, which is, the Fed's target is 2%. But I think if we were sitting here in 2028 and we said, well, what was the last 5 years annualized inflation? And it was 3%. I think a lot of good things could happen in the economy and the markets if that's what actually gets realized. I haven't shown this before. I thought this was interesting, but it just shows pricing, wages, and sales expectations for businesses. So, and what it's really showing here is that a lot of companies plan to increase pricing in the next 3 months. So they think they're going to raise prices a lot, but fewer of them think they're going to increase pay. But they also think that sales are probably going to be lower. So that's kind of an unusual setup, and it does sort of suggest some of these other periods where we have seen a recession coming. But I think the good news there is, at least if you're an inflation hawk, that suggests against inflation. If people are going to pay people more, but sales are going to go down. So housing is an important part of what we're looking at here. And I think, if anything, the struggles of the housing market caused by the Fed raising interest rates have helped cool inflation more than maybe anything else, because regardless of what your actual economics are, if you feel like your house is not appreciating or even potentially losing some value, it probably has an impact on all of your spending decisions and economic decisions. So you can see that the 30-year mortgage has gone to 6.2%, which is down from its peak recently, but still, we really haven't seen these levels since 2008, 2009, 2007, somewhere around in there. Again, my first mortgage, which was in 2007, was at 6.25%. So that is about where we are now, which is hard to believe, especially after this period here. And it looks like housing prices have started to decline, but of course, this is one of the most lagged indexes that we look at. The latest data point is still from October. So it wouldn't surprise me if we've seen some real house price declines even since then, which again, actually could be good for a few reasons. Obviously not if your house is worth less, but in general, it might make housing more affordable and help taming inflation expectations. And just to go back as a reminder, let's see, go? I think it was here. The problem is if you look at shelter here, rent of your primary residence. So if like you rent an apartment, there is some inflation there that actually is happening because I think landlords are trying to raise rents and things like that. But owner's equivalent rent, that's the price of houses. And the way it's determined is they go to homeowners and they say, if you rented out your house today, how much would you rent it for? How much do you think you get? And this completely unqualified person who doesn't look at the real estate market, rental market, and might have lived in the house for 20 years makes up a number. And that survey is what determines essentially the house price impact to inflation. So it looks really high here, but that doesn't really line up with actual data, which, let's see. And the actual data here is that house prices actually are falling as part of the Fed's quest to raise interest rates. You can see housing starts have definitely fallen. And if you look down here, the mix, really multifamily is held in there and single family is the one that's declined. So the good news there is that maybe that'll help support house prices, which are obviously on the decline, but maybe that'll help the fact that multifamily is still increasing might help this rent a primary residence number, which is right now a real contributor to inflation. So I think that's probably good news. I mean, this tells the same story. Building permits are down. Existing home sales, this looks very dramatic, but if you look, the bottom axis here is 4,000. So if you actually put it down to zero, it wouldn't look quite this dramatic, but there's no question that house sales are on the decline rapidly, and they might have to add another part of the scale here because it looks like it's going to drop below 4,000 here next month. So, or in January. So I think that again, that probably is helping with the inflation story. Inventory of houses is pretty high, which again, probably not the best time to sell your house. Mortgage refinancing is, so the gold here is actually the 30-year treasury yield, which is what a lot of, mortgage rates are generally driven off the 10-year or 30-year, but you can see refinancing has really just been decimated. It's peaked just a little bit because we did see a little bit of a recovery or a little bit of a drop in mortgage rates, but there's a lot of people that they're very much stuck either in the city they're in, or even if they want to move within their city, they don't feel like they can abandon a mortgage at 2.25% when the new mortgages they're getting are at 6%. So this definitely will impact mobility for some time for a lot of people. We're drawn to the end here, and we kind of save the actual stock market stuff for the end because again, that's there's so much other stuff going on. We don't want to dwell on this and lead with it, but we'll go through this quickly. But you can see the S&P peaked and is fallen. It was down about, the total return was down about 18% in 2022. But the good news is the S&P 500 is not the market. It's just a gathering of US large cap stocks. And there's an awful lot of other stuff that you invest in if you're here at Telarray. I mean, we're in small cap stocks, we're in international stuff, value, emerging. There's a lot of different things that aren't reflected at all in the S&P 500. And again, I don't want to talk about specific performance, but it's hard to find a position that did much worse than the S&P 500 in your portfolio in 2022 if you're a Telarray investor, and you can look at your statement and see that we have a lot to be proud of about our individual security performance in the things that you're invested in. And again, we like to put this up. It's going back 100 years or so, and what it really shows is there's just never really a particularly bad time to get into the market. That even the precipitous drop in the COVID lockdowns or the global financial crisis, it's all just part of the plan. And if anything, it's a chance to, and then people always talk about the lost decade, where from the peak of the tech bubble all the way out to about 2010 or 2011. In this case, the S&P 500 didn't go anywhere, but of course, other stuff did. If you were diversified and if you were working, these were just opportunities to buy lower when you had the money available throughout the time. And even if you're a retiree, if you had an appropriate plan, you'd be, in these drawdowns like this, you'd be ready to pull on your bond positions or short-term reserves and things like that, so that you could weather these storms, and then still participate when things took off after that. So, and what I always tell people is, if you were going to retire today, if you're going to retire in January of 2023, and you thought about all the times you invested money in the market, you'd never look back and say, well, I really wish I hadn't gotten in 2 weeks before Black Monday, because I could have bought, that much lower a few weeks later. You would be so thankful that you put any money to work you could anywhere around here. And really, if anything, you probably just wish it was further to the left. So these people that hold out of the market for months or years, or try to time things and then get discouraged because they miss something, it's just so much emotional overhead. And again, if you were sitting here today, looking back since, say, if you've been working since around 1980, you would just wish you put as much money in the market as you could have as early as possible, is really, I think, the emotion that most investors would feel. And they probably would be thinking they wish they hadn't bought, some frivolous thing or another in 1986, because if they'd put $5,000 in the market then, it's you can do the math, but it would be a meaningful windfall today if that money had been to work the whole time. We always like to show this, because what's interesting about it is the gray shows consumer sentiment. I think it's University of Michigan consumer sentiment. And what the blue dots show is the 1-year performance in the S&P 500 following these troughs of consumer sentiment. And if you've watched these, you've probably seen this chart a lot. But the bottom line is, whenever consumer sentiment gets low, then the market returns have generally been extremely favorable following that. And when consumer sentiment peaks and everybody thinks it's a great idea to get excited about the market or Bitcoin or tennis shoe collecting or whatever it is people do, the market returns are generally reasonably tepid to even unfavorable after that. So if you believe in this metric, you'd be very excited to note that in late 2022, we did have a bottom in consumer sentiment, which you hadn't really seen since 1980. And if that's any indication, then 1 year out from that, market returns might be very favorable. And it seems at this point that we're on track to see that, although there's still a lot left in the year since we saw that trough. But that's a very encouraging thing if you're hoping the market will be strong in 2023. This is a valuation measure for the S&P 500. It's the forward PE ratio. So looking at 1-year earnings estimates compared to the current price compared to 1-year earnings estimates. And you can see that we were kind of overvalued by this metric, but really we've settled in to be right in line with the 25-year average for the S&P 500. So if you believe in this indicator, you would say, well, it's not a great time to invest. It's not a bad time to invest, but it's probably just as good as any time to invest if you look at the S&P 500. And again, just kind of like I said, I wanted to look at international stuff more in these presentations. I would love it if we could, and it's something we can probably do, is spend some time creating these internally to look at, rather than saying, let's look at the stock market and say the stock market is in the S&P 500. Why don't we actually build these charts with some other indices that actually are more meaningful and more representative of the style that we try to implement in your portfolio? So we'll work on that. This chart shows value versus growth, which, as a refresher, value really just means cheap stocks and growth really means expensive stocks. And you can see that value did have a rough time for the last 10 years or so, but in the last couple of years, value has really been on fire. And you might say, well, value's done so well in the last couple of years. Is it played out? Is it over? And the answer is, first of all, nobody knows, because value or growth, or any two polarities, can underperform or outperform much longer than we can stay solvent, as the old quote goes. But what this means is, to me, it's really not played out at all. There's still room for value to run before it even gets to the long-term average of the relative value of growth and value. But you can see there's a lot of observations in the past where value becomes very overvalued compared to growth. And there's no way of knowing exactly how this chart's going to go, but I don't feel like it's ready to consider. I don't think it's time to consider a serious strategic shift away from value just because it's been successful the last couple of years. And I think this chart reinforces that. This chart is pretty wild. There's a lot of lines here, but if you just look at the gold line, that's the performance of the S&P 500, which is up 42% since I think this starts at the beginning of 2018, maybe. But this was the rise of the FANG stocks. This was when these big tech companies, they're listed up here, just were so dominant. One guy that a market commentator and investor named Jeffrey Gundlach, he would say that there's really the S&P 500 didn't even matter. It was really the S&P 6, which was the FANG stocks, and then the S&P 494, which kind of did nothing for a while. But what you can see is what goes up usually comes down. In the case here, this blue line, really since the beginning of 2022, it was just a really rough year for growth for tech, which was very validating for us because we're relatively underweight those things. You can see it's recovered a little bit, but right at the end of 2022, actually the FANG stocks had given up every bit of their performance relative to the S&P 500, which is a little bit reflexive because a big part of the S&P 500 is made up of FANG stocks. So, but with that said, I mean, obviously you can see the blue line crashed precipitously and the gold line went down too, probably because the blue line was going down. But the point is that it just goes to show that, right here, you wouldn't think to chase it right here, but, around here, you might say, well, I've made a huge mistake. I should just be in the FANG stocks and throw everything else away. And of course, that's the time when everything reversed. So I would much rather experience the gold line and just be more diversified and have a more smooth ride than have the exuberance of that huge run up and then the depression of that huge fall. So I think that just goes to show that, and it's real interesting to think about what's going to be next. I think I've said on here before that toward the end of the year, the Dow Jones Industrial Average, which is just 30 stocks picked by the editorial board of the of the Wall Street Journal, the Dow did really well. And then suddenly people were saying, when they looked at, say, 5-year returns, they said, well, the Dow did so well for the last 5 years. Why didn't we just buy the Dow and ride it out? And the answer is that never would have occurred to them if it just so happened that the Dow hadn't taken off toward the end of that period. So in the same way, you're not hearing a lot of excitement about the FANG stocks right now, but it's not clear exactly what is going to replace them as the next hot topic in investing, which maybe it'll be emerging markets, maybe it'll be value. That would definitely be good for us, but because that's the kind of things we tilt towards. But at the same time, I wouldn't probably even hope for that because I wouldn't want to see a bunch of hot money go in and really drive them to get overvalued and then have it all go away and have a bumpy ride like this. Of course, since we do rebalance portfolios, we would be able to take advantage of that scenario because, as the kind of things we hold were sort of rising in value, we'd slowly sell them and reinvest the proceeds and things performing less well. But in general, I'd much rather have a smooth path to our secure financial future rather than a roller coaster. So we're running a little low on time, so I'm just going to keep going. I think this is interesting because it compares the S&P 500's PE ratio, which is just a look at how much each dollar of earnings costs to buy if you're an investor. The U.S. is definitely pretty highly valued. Developed non-U.S. is more attractive in the sense of it's cheaper, and then emerging looks even more favorable. And what's interesting is we've started tracking this about halfway through the year last year. Closely related to price to earnings is price to earnings growth. So you might be surprised that a company with good earnings, the value of it is not that. It doesn't help to have good earnings if those earnings aren't growing over time because inflation erodes it and there's competitive issues and all kinds of things. So if you look at how much it costs to get a dollar of earnings growth, which is the price to earnings growth ratio, you can see the U.S. is actually much more favorable compared to developed markets, which are very expensive on this scale, and emerging look favorable here as well. And part of the reason for that is going back here to price to earnings. Developed markets look cheaper here, but they really suffered as part of, and this is Europe, developed Asia, things like that. They really suffered with the geopolitical stuff, with the invasion of Ukraine and natural gas, and again, since they're non-US dollar currency users, they really struggled with the strength of the dollar, making energy more expensive. So that was part of the reason this peaked so quickly. And now that the dollar's backed off here toward the end of the year, you can see their price to earnings growth is going back to a more reasonable level. And the good news is that's happened even as the stocks have performed very well. Again, in the last quarter of 2022, the price of these stocks went up pretty meaningfully, which you would think would drive the price to earnings growth higher. But actually what happened is, even though the price was going up, the earnings growth accelerated more, making it cheaper on this metric. So that's good news for Europe and Asia, and it's been good news for our portfolios. So we just have a couple more slides here. I really like this one because it just kind of shows, again, why I wouldn't say we're bullish. I wouldn't say we think we know what's going to happen, but it makes me optimistic about emerging markets just because there's so much growth there. And in particular, I'm referring to the growth of the middle class. So you can see the places that are causing middle class growth, which probably the worst ones here are North America and Europe. You can see that the expected contribution of new consumers to the middle class is very tiny for North America, and it's actually negative for Europe. People are actually going to fall out of the middle class in Europe. But you can see Asia Pacific, which is India and China, and then a little bit of the rest of Asia, is a huge driver of that over the next 10 years. But what's fascinating is they are starting to build out a real middle class, but places like Sub-Saharan Africa, Middle East and North Africa, Central and South America, they don't have a huge middle class. I mean, I'd say Central and South America maybe more so than these other places, but these are kind of the next ones to go. So even as the rest of the economies in the world mature, we've got a lot to be excited about in Asia Pacific. But then even after 2030, we'll likely see these bars start to grow, and all the more reason to be invested in a diversified manner outside the US and particularly in these emerging economies. So the last thing I like to show is, if I had one chart, if I had one metric to think about the future, 2023 and beyond, I would say global GDP growth. So that's real GDP. So even after you take prices into account, price changes, as long as the world's GDP is growing, economic growth is occurring, then we're probably going to be okay. You can see there's a pretty big drop there in the 2008 recession. There's a huge drop just in a short time with the COVID lockdowns. But what you can see is we've already sort of had a negative observation in global GDP growth in 2022, but it's actually picked back up and it's trending upward. And this last observation was in the fourth quarter of 2022. So this is an aggregate of the whole world. So of course, the US could go into a recession, or some other country could, or we could all go into a recession. But the bottom line is, the fact that this is trending upwards is, I think, a really good sign. And it almost contributes to that idea that maybe it's possible that maybe we have already experienced a very mild recession and we're on the back half of it now, or maybe it's even starting to draw to an end, and it's going to be a few months or quarters until it actually gets declared and everything. So maybe everybody's right that a recession is on the horizon, but it actually might be in the sunsetting direction rather than in front of us, possibly, which would be nice. But again, either way, we're not here to guess one way or another. We just try to be consistent in our investment approach. We try to monitor everything we can. Just because things in your portfolio aren't changing doesn't mean we're not paying attention. Again, we are here at Telarray, we're free from affiliation with any kind of parent company or bank or insurance company or any sort of product business. So we really can put essentially whatever we think we should in the portfolios. I mean, we really can put our best foot forward with our best ideas, and that's what you've got. I think we're unique because some companies talk about just customizing portfolios, and we do to an extent. You can have as much bonds or stocks in your portfolio as you need, but really, we really primarily have all of our clients invested in the same idea, which is our best idea. It's the same way we invest. It's one set of model portfolios, and we're very proud of how we did in 2022 in a relative sense, and we're very optimistic about 2023. So Nobody knows what will happen, but if you're a Telarray investor, you'll be invested. And I think whether or not things work out perfectly in 2023, you have a lot to be optimistic about in the coming years and decades. So again, thank you for entrusting us with your financial future. And if you have any questions, please reach out to me or your advisor. And I don't see any questions right now. So we did go 1 minute over, probably because Chelsea isn't here to bring the iron fist of moderation to us. But I hope I can get that minute back to you somehow someday. And we appreciate you joining. So again, here's my contact information. You can reach us here or me or your advisor directly. And we appreciate you listening. So thanks so much for joining.